Okay, folks, welcome back. All right, so we're going to pick up where we left off. This is Show Me the Pips post. Hi, Michael. I have a couple more questions in relationship to open interest as well as my below questions, and you didn't listen. I asked you guys to give me like one question per post. You guys keep adding to the books that you're already writing for me. So, all right, so in relation to open interest as well as my below questions I posted 10 days ago that haven't been flagged. I believe I probably already got to them by now, but is it fair assumption that participants selling out of the money contracts are typically going to be smart money due to the additional capital required to participate at this level, especially when trading out of the money contracts to take only 5% a month from that level of exposure? It's not always going to be smart money, and out of the money options are actually cheap. They're very cheap. That's why they're out of the money. In the money or at the money options are generally they're ones with the most premium, and you're going to pay more for them because they're most likely going to be profitable because of the near-term fluctuation in the underlying asset. So I don't feel that it's a fair assumption, at least this is my opinion. I don't think that a perception of looking at out-of-the-money contracts being accumulated, being attributed to just being smart money, because I know a few options traders that make their living just on options writing. And while they do very well, they aren't typically an entity or an institution that would be deemed smart money. Now, they may have smart money characteristics in the way they do it, but I don't believe that that's the case. No, that's my personal opinion. With that being said, should we be doing further analysis, monitoring the percent changes of open interest in out-of-the-money contracts, especially tracking changes in position on contracts that are near expiry? Might complement the premium discount nearby contract concept you teach. Again, I don't read that much into that. And you're saying that you have a screenshot here showing the open interest of silver December contracts with a split of calls versus puts. Okay, and obviously you can see there's a discrepancy with a larger interest in the call side versus the puts. Whenever I'm looking at the relationship between calls to puts, I want to have a scenario where I'm expecting a sizable move one way or the other. And because option traders generally are pretty savvy traders, they're very smart in the way that they do it. The ones that are successful. Now, obviously, there's going to be people like myself when I first started trading commodities. I dabbled. I had no idea what the hell I was doing. So you know the story with that. First option trade I did was orange juice, and I lost money. So by far and large, generally option traders are option writers. Okay, so there's a lot of folks that are just basically passive investors that do a lot of size sometimes in options, especially when trading the S&P call options and put options. There's a big market in trading those, but I like to look for the relationship between call to put activity and relationships, or ratios, if you will. For instance, if my tools are suggesting, for instance, a time in the fall where we will be underlying bullish. Okay, we're looking for a reason to be a buyer in the fall. And if that's the case, then we get a seasonal influence coming, and we got technical supporting all the smart money concepts that I've taught you, and it's time to be a buyer. I like to see them showing a great deal of interest in puts. Okay, so I want to see the puts being heavily active. Therefore, the premiums on the put side is going to be very, very, very expensive, and it's going to be very cheap for call options. So the put to call ratio will be favoring a undervalued call option market. All right, so would the displacement of out of the money strike open interest be a good method for exposing commercial positioning? Again, I don't think that's something that I personally would subscribe to. But because, again, a lot of the option writers, they know that there's going to be a willingness to see the market participants buy these out of the money, really, really cheap options, because the premium is going to be so low. It's going to be enticing for them, especially if you see like a big move and say there's a big explosive move in for instance, soybeans. Okay, we saw one earlier this year. Near the top of that market in the soybean market, obviously the implied volatility would be extremely